Our next guest is worried about the future beyond the latest political skirmish as rates are poised to rise above 5%. Joining us now is the National Bureau of Economic Research CEO, James Paterba, the man who holds the key to whether we're in recession, which I know you're not going to announce here, Jim, but are you getting worried?
Sarah, it's great to see you again. I think that I don't have a fix or a solution for the near-term issues around the debt ceiling debate. That's politics more than economics. But, I think it is worth recognizing the long-term backdrop against which this discussion is taking place. And that is just that the U.S. faces a structural deficit in terms of our federal funding as we look out to the decades ahead. It's a complicated calculation to do, and it requires some forecasting over very long horizons. But if you just look at the programs that are on the books today and what those are likely to cost going forward, and the tax revenue sources that we have, it looks as though over a 2 to 3 decade horizon, we run a sort of 3% of GDP deficit without any obvious way of getting that to improve. And of course, the dynamics of this is challenging because as you run those deficits for a longer period, you begin to build up more debt to GDP. As the debt to GDP ratio rises, you begin to pay more in interest, and the interest itself then contributes to the deficit as you go forward. So when you look at the forecasts, whether they're made by the CBO, by the IMF, by Bill Gale at the Brookings Institution, Alan Auerbach out at Berkeley, they all suggest that much higher levels of debt to GDP lie in our future as we look out to the 2040s and 2050s.
That's a problem, what you just painted there. And it hasn't really been a problem for the U.S., right, as long as we're the reserve currency, until it is. Are you suggesting that we're reaching some sort of tipping point?
It's really hard, Sarah, to pin down a tipping point. Some people will recall over a decade ago, there was a lot of discussion if you crossed 90% of debt to GDP, that was going to unleash various things. We've crossed it and it didn't have those consequences. And part of the discussion around the burden of the debt, that the debt to GDP per se may not be the exact right metric to focus on. It may be more important to think about what it actually costs you to service that debt, which focuses maybe on real interest costs as a share of GDP. One thing that's happened in the last 2 years, of course, is the really dramatic change in real interest rates, and that has pushed up the burden of the debt stock that we already have. If you look at the history of, say, the 10-year real interest rate estimated by, say, the Cleveland Fed, we're at a number today that is on the order of maybe 1.5%. That number was under 1% for most of the decade between 2010 and 2020, but it was close to 2% in the first decade of this century, nearly 3% during the 1990s. So, depending on where that long-term rate lands, the burden of this debt stock becomes much greater. When the debt to GDP ratio is around 100%, which it is today, that just tells you that an additional 1% real interest rate increase is costing the federal government another 1% of GDP every year as we have to service that debt.